All right, let's talk about something we all think about. How do we grow our money without that constant nagging fear of losing it all when the market gets shaky? Well, today, we're going to break down a really powerful strategy that's designed to give you that market upside, but with some serious protection when things go south.
I mean, this is the million-dollar question, isn't it? You see the market taking off and you think, man, I've got to get in on that. But then you remember that what goes up can also come down hard. The thought of a crash just wiping out your savings is, well, it's terrifying. So is there a way to get those gains without all that risk?
And that feeling right there is what we call the saver's dilemma. It really is like a constant tug-of-war. On one side, you have that drive for growth, to see your money work for you. And on the other, you have that deep-seated need for safety, for security.
So what does this choice usually look like? Well, on the growth side, you're basically strapping in for a rocket ride, right? You're jumping into the market, hoping for those high returns. But on the safety side, it's like locking your money in a vault. Yeah, it's secure, but meanwhile, inflation is just quietly eating it for lunch year after year.
It really feels like you have to pick one or the other, doesn't it? But what if you didn't? What if this is a false choice? Let's explore a totally different way of thinking, one that truly tries to give you the best of both worlds. So just imagine this for a second. What if you could connect your money's growth to a major market index, like the S&P 500? So you get to ride the wave up, but, and this is the absolute game changer, you never lose a dime of your principal or previous gains when the market has a bad year? I know, it sounds almost too good to be true. This is the whole idea behind a strategy called Indexed Universal Life, or IUL. Let's see how it actually works. Okay, to make this super simple, let's use an analogy. It's a great way to visualize what's happening. Think of your money not as a number on a statement, but as a climber on a mountain. This really helps it all click into place. So first things first, the climber. That's your money. And the goal is pretty simple, right? Climb higher and higher. That's it.
And the mountain our climber is on? Well, that's the market index. Let's say the S&P 500. So when the market has a good year and the index goes up, our climber, your money, goes right up with it. They're gaining altitude.
Now, there's always a trade-off, right? In exchange for the safety we're about to talk about, there's something called a cap rate. You can think of it like a ceiling that limits how high our climber can go in a single year. So even if the market goes nuts and shoots up 20%, your gain for that year might be capped at, say, 12%. This cap is the price for that incredible downside protection.
And here it is. This is the magic. What happens when the market falls? When it drops 10, 20, 30%? What happens to our climber? The answer is nothing. Absolutely nothing. A safety net appears, and our climber doesn't fall back a single inch. Your value is locked in. Your worst-case scenario is zero gain. But, and this is everything, zero loss.
And this visual just brings it all to life, doesn't it? You can see the value taking these steps up. That's our climber in the good years. And when it hits that upper limit, well, that's the cap. But look at that flat line when there's a drop. That's your safety net. That is a solid floor. There is no fall. Okay, the climber analogy is great for getting the concept, but let's see what this looks like with some actual numbers. Let's walk through a quick, hypothetical 2-year scenario to see how this plays out in the real world. All right, so imagine it's year 2, and yikes, the market hits a rough patch. It drops 10%, a pretty normal down year, and the kind of thing that usually gives investors a ton of anxiety. But with this strategy, what happens to your account? You get a big, beautiful zero. That safety net deployed perfectly, you didn't feel that 10% loss at all. That is the incredible power of zero. Now let's put it all together on this slide. Check it out. In year 1, the market is on fire. It's up 20%. You get a really solid piece of that action, credited at 12% because of the cap. Awesome. But then year 2 comes along. The market tanks by 10%, and you get that beautiful 0%. You're completely protected from the loss. You capture a healthy chunk of the gains, but you sidestep all of the losses. So now that we get how the engine works, how you get that growth with protection, let's zoom out a bit. Because this whole strategy is way more than just a one-trick pony. It's actually built to be a multi-purpose financial tool. And this image really lays it all out. As we said, this strategy is built inside a tool called an Indexed Universal Life Policy. And it's designed as a 3-in-1 solution. It wraps a life insurance protection component around that cash value account we've been talking about, which you can use for all sorts of things like emergency funds or even to supplement your retirement income down the line.
And when we say protection, we're not just talking about the market. This thing is designed to be a safety net for many parts of your life.
Of course, it has that core life insurance to protect your family, but it can also include things called living benefits, which can be a huge help during major health events. And as you can see here, it even has features built to protect you from taxes and creditors.
And here's another massive piece of the puzzle, the tax advantages. Your cash value grows tax-deferred. Now think about that for a second. That means you aren't getting hit with taxes on your gains every single year, which lets your money compound so much more powerfully. And later on, you can often access that cash value as a source of supplemental income, tax-free. That's a huge deal.
So when you put this all together, what are we really talking about? Look, the point isn't to try and beat the market every single year. It's about a smarter, more stable way to grow your money for the long haul. It's about avoiding those devastating losses that can totally derail your financial future. So I want to leave you with this one thought. If you could completely remove the fear of losing money in a market crash, how would that change the way you think about your future? How would having that balance of growth and real, solid protection give you the confidence to plan for the life you really want? It's definitely something to think about.